Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500 and today is Campbell Soup Company, ticker CPB. Over the next few minutes, I'll discuss most of my thoughts on the valuation of this company and its business quality. This business is a $14 billion market cap, $18 billion EV, so we can see about $4 billion in net debt here, operating in the food products industry. Here's your business description. Campbell Soup Company manufactures and markets food and beverage products in the United States and individually. This tends to be a relatively good business. They operate in the meals, beverages, and snacks segments. So let's see if we can see some of their brands. You have Swanson Broth and Stocks, Pacific Foods Broth, Soups, Prego Pasta Sauces, Pace Mexican Sauces, Campbell's Gravies, Pasta Beans and Dinner Sauces, Swanson, Plum Baby Food, V8 Juices, Campbell's Tomato Juice. Snacks include Pepperidge Farms, Crackers, Fresh Bakery, Fresh Milano and Goldfish Crackers, Snyder's, Large Sandwich Crack, Cape Cod, Kettle Brand, Potato Chips, Pop Secret Popcorn, Emerald Nuts, and other snacking products. So, you may recognize some of those names. I certainly recognize some of those brands. Branded food and beverage products tend to be a very good, high-quality industry. Let's see if the numbers play that out. The beta of 0.392 is really low for an S&P 500 company, so it would generally suggest a relatively low volatility for the company, which tends to mean that the stock is also a little better, but it's really something we have to dive into. Now, return on invested capital, the first thing you see when you look at this is there's no years of losses in the last 20 years. That's a great sign. Anytime you have 20 straight years of profitability, that's a very positive point in the column for the business. What I don't like is you can also kind of draw a trend line that these numbers have been getting a little worse over time. I don't like to see returns on capital getting worse over time. And there is some cyclicality to the business. It's hard to really understand why that might be from what we see here. But again, starting in 2002, 2007, these 15 to 20% range, really good numbers. You get up to 29% in 2008. So even in a recession, they're performing admirably with 29%, 20% return on invested capital. Now, 2010, if we look across the past decade, is when you really start to trend down. 23%, 2020, 9, 15, 12, 10, 17. So really, if you exclude 2018 and 2019, you have good numbers here. They're all double digits. You want these numbers to be double digits. You only have 3 years where it's not double digits, which is 2013, 2018, 2019. But overall, still really good numbers, even though they're downward trending. I like what I see here for those 10-year median returns. Again, downward trending, but return on invested capital of 11%, return on equity of 44%. Really, really good numbers. Now, price to equity. Let's look at our valuations. PE of 15. Strong here. That's a very attractive number. I like to buy companies around a PE of 15 or less. That's really a good area where you can trust that if it's a high-quality company, that's what the average business of the S&P 500 typically would trade at over time. So if you get a company that's above average, for an average price, that's good. If you can get it for below 15, then you're going to get above average company for a below average price. That's even better and can really set you up for strong returns. However, with that said, what I don't like here is this 10-year CAGR on revenue and assets. And this explains what we were seeing here. So you have a 10-year revenue growth of 1.7%. It's good that it's growing, but it is slow. But you have asset growth of 5.5%. So you're going to have declining return on invested capital when your assets grow faster than your revenue, faster than your free cash flow, and faster than EPS. That's what you see here. So that is an area of concern. And it's something I'd want to watch as an investor. Now, something that's interesting here is you can see that the gross margin is all over the place when we dive further into these statements. And that's really important because it's telling you a bit about the strength of the business. Higher quality companies have very stable gross margins. This is not a stable gross margin business, 39%, 36, 35. Those are close together, 34, 36. Then it's jumping up and down. You jump up to 41% in 2017, down to 35% in 2018, down to 33%. They don't have the bargaining power to maintain their pricing power with these gross margins. That's a big concern for me, and it makes it really hard to predict the future of this business. That's all despite these numbers that you see that look overall pretty good, but it explains both the cyclicality here and your downtrend. Now, you began the decade with $2.41 in earnings per share, and you end at $3.29. But you have years in here that are substantially lower than that. You have $1.44, $2.13. So you had 2012. And then you had 1, 2, 3, 4, 5 years below the 2012 number. So if we look at 2021 and we think, okay, over the next decade, we should maybe expect 5 years of earnings per share below $3.29. I don't like to see that. That makes it really hard to predict my future performance. So I love these returns on equity, but I don't love the business and how it's being managed. If you're enjoying this video so far, please hit the like button. Your likes help me to grow the show audience. So if you don't hit that like button, I won't be able to grow the show. If you're enjoying my videos, you need to hit that like button on each and every video to help me continue to grow. If you're enjoying those videos as well, don't forget to subscribe, because I'm working through every company in the S&P 500, and your subscription can let you get notifications as I upload new videos each and every week on individual companies. Now, income statement. We can see here that the gross profit has actually declined over the last decade. So you have had revenue growth, but your gross profit is lower today than it was a decade ago. That's a really bad sign for your ability to continue to grow. You're not growing, and you're not having the pricing power to really build those long-term returns. Lack of growth is really, really concerning, because if you're not able to grow, then your earnings, your PE of 15 is actually still too high. PE of 15 is something like a 6% earnings yield. And so you need 4% growth to even justify a PE of 16. If you have no growth or negative growth, you really need to be paying a PE of like 8. 8 is a good PE to pay for something that's a no growth company. 8, 8.5, 9, somewhere in that range. So to me, this company could even be 50% overvalued by what we're seeing on this income statement. Now, you do see your net income growing, but part of that, I think, is this shares outstanding is declining over time. You are using some money to buy back shares. I do like to see that. That's a really good sign. But you have flat operating profit. So they're also benefiting here that income taxes has gone down over time. So even though you have flat operating profit, you're converting to more net income because you have lower taxes. So again, it's stuff outside of the company's control that might be working okay for them, but the stuff in their control isn't. You can see they've had to make some acquisitions, especially in 2017, 2018, to make that growth that's growing that asset, goodwill, intangibles. And so they've had to make acquisitions simply to maintain the same size. Again, not a good sign, not what I like to see. Cash flow, we can see they do pay stock-based compensation, but they're also generally buying back shares more than that. But that's a lot of stock-based compensation. Actually, I guess it's like 10%. Let's see, how much of their cash flow? It's like 10% of their cash flow. It's not terrible. They're still maintaining a lower net issuance, but they're also, I don't like this. So for me, these numbers are just not very appealing. The business is completely unpredictable. So despite these really good median returns, despite what normally be an attractive valuation ratio, I would say the company's overvalued at a PE of 15. I would say these returns aren't really relevant because they're unable to grow. These returns would matter a lot if they were growing, but because they're not growing, they don't matter at all. And so a company that's not growing can't really use its high returns on equity. You need growth to justify that. So for me, I'm going to pass on Campbell Soup. It doesn't hit my watch list. It's a high quality, no growth company. And those are companies I tend to avoid because I need that growth to really compound my performance over time. Thank you for listening. And if you enjoyed this video, please hit that like button. Please subscribe and ring the bell so you can get notifications as I upload new videos each and every week. Thank you for listening. Until next time, stop paying fees, start building wealth.